Well, hello everyone. Thank you for joining us today for the last in our series of not-for-profit accounting and auditing topics. And today's session is going to focus on ASU 2020-07, which is presentation and disclosure for not-for-profit entities for contributed non-financial assets. My name is Angie Hillestead, and I am a partner in Eide Bailey's National Assurance Office, and I am located in our Sioux Falls, South Dakota office. If you are joining us today from South Dakota or from anywhere in the Midwest, we definitely have our blast of winter that has finally arrived. It's a balmy 30 degrees here today with a little light brushing of snow. So I think we were all maybe hoping that it was going to stay fall forever, but that is not to be. I am happy to be here with you all today. A little bit about my background is that I am a partner in our National Assurance Office, and I work primarily with not-for-profit organizations throughout the firm, all shapes and sizes, all types of organizations, and provide a lot of support and assurance to our assurance team as they work with their not-for-profit clients. Today's session is going to provide an overview of contributed non-financial assets, and we'll also look at the changes in presentation and disclosure requirements effective with the implementation of ASU 2020-07. We're also going to take a look at some illustrative examples of the new disclosure and presentation requirements, and we'll also talk about the effective date and transition requirements of the standard. To understand really what's covered by the context of the contributed non-financial assets standard, I wanted to first focus on setting a really good baseline understanding of non-financial assets. Very simply, the accounting standards define a non-financial asset as an asset that is not financial in nature. So that's maybe not very helpful in and of itself without an understanding of how the standards define a financial asset, which is cash, an evidence of ownership, interest in an entity, or a contract that conveys to one entity a right to receive cash or another financial instrument from another entity. Basically anything that is a close tie to cash or to ownership interest is considered a financial asset. So today we are focusing our discussion on non-financial assets. This is going to be things that include tangible fixed assets, things you can touch like land, building, equipment, furniture, those things that you can put your hands on and feel, maybe move depending on the size. It's also going to include the use of fixed assets or utilities. So maybe what your non-financial asset is that someone is allowing you to use property without paying them rent. That's a non-financial asset to your organization. It also includes materials and supplies. Maybe somebody is donating to your organization some key supplies that you use in putting together food bags that are delivered to the community, things of that nature. Non-financial assets also include intangible assets. So these are things like contributed fundraising materials or informational materials. How do you get your word out to the public? Does somebody donate that to you, that information to you, and allow you to benefit from those services that they provide without paying them? That's an intangible asset. It's advertising media time. It's any sort of time and space that an entity like that is providing to you without charge. Contributed non-financial assets also include contributed services. So if you are receiving services to your organization and you're not paying for those services, depending on the level and type of those services, those may be transactions that you record in your financial statements. It also includes contributed collection items, as well as unconditional promises to give any of those non-financial assets. So something to think about when we think about non-financial assets is that we'll use that term contributed non-financial assets interchangeably with gift in kind. So the two are really one and the same. Sometimes we might refer to these as gifts in kind, and sometimes we might refer to them as contributed non-financial assets. Accounting guidance requires that contributions, including contributions of non-financial assets, be recorded at fair value in the financial statements. For various reasons, this can often cause some really interesting measurement challenges for not-for-profits when entities are trying to determine the value of the contributed non-financial assets. In some circumstances, your not-for-profit might be accepting an asset that does not have an active market. That is, determining the value might be difficult because there are not common transactions or comparable transactions in the marketplace for you to look at. In other circumstances, the items that you are accepting, you might be accepting solely because someone is donating them to you, but they're not things that you would otherwise purchase on your own. And so that can make valuation difficult because you don't always know or understand what the real value of that contributed non-financial asset is. And in some other circumstances, the donated items might not be things that are being used at their highest and best use when they're used by the not-for-profit. Yet you're still accepting them because they will provide some sort of value to your organization. These are all really important factors that you need to think about when determining fair value. So these are things that can impact that fair value determination. But all that said, a contributed non-financial asset that is worth accepting generally possesses some kind of value. That is, there's some type of future economic benefit or service potential that you are going to be receiving, or you as the not-for-profit would not have accepted the gift. This means that if a not-for-profit is accepting a donated financial asset, it should likely be recorded in the financial statements, even if it's difficult to value. So what you'll find is that difficulty in valuing a non-financial asset does not preclude recognition. Sometimes it's just going to take a little bit more work to determine what that value actually is. It's one of those things that when we think about valuing a non-financial asset, it's not straightforward like it is with a financial asset. If somebody gives us cash, we know what the value of cash is. $10 is $10, $100 is $100. There's a defined value when it comes to cash. Same with marketable securities, which are also financial assets. They can be traced to like sales. If somebody donates to your organization a share of Coca-Cola stock, you can go to the marketplace, you can see what Coca-Cola stock is trading for on that day, and you can determine very easily a value of that stock. It's common, it's straightforward, it's not very subjective. But for most non-financial assets that are common for a not-for-profit to receive, the valuation process is less clear, and it does have a lot of subjectivity. So what is fair value? Simply the accounting standards define fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. What does that really mean? Very simply put, fair value is the price that the market would bear in a transaction between an unrelated buyer and an unrelated seller that enter into that transaction willingly. So what we're thinking about here is not to say that related parties cannot enter into transactions with each other. Rather, the value and price of that transaction might not be indicative of the fair value. We want to really take a step back and say, if I was a buyer and I was purchasing something from a seller that I had no connection to, what is the price that I as the buyer would be willing to pay? And what is the price that the seller would be willing to sell that product to me for? If we can arrive at that, we're close to fair value. The other thing to consider, though, is whether that transaction was entered into willingly. Because if there's a forced sale, or if we're thinking about a buyer and a seller, and the seller is needing to get rid of something because of financial problems or other issues, that could be a twist that might impede what fair value is. So again, just thinking about this from the aspect of we've got a buyer, we've got a seller, they are not connected, and they're willingly entering into a transaction. An entity can determine the fair value of contributed non-financial assets in several ways. I'm really thinking about what might be relevant for the type of non-financial asset that your not-for-profit is receiving. If the gift in kind is a donated good or service, the not-for-profit entity can look to see what paying customers are charged for similar goods and services. And that might even be a case where they are the customer. So let's say that, we've got a janitorial service, and the janitorial service decides to come in and they're going to donate their labor, part of their labor, to your not-for-profit. If you've determined that that's a contributed service that can be recognized in the financial statements, you might estimate the value of that by looking at how much you pay for an hour of undiscounted janitorial service. If it's something that you're receiving that you're not a current customer of, you might look out to see what other similar entities are paying for similar services. If the gift in kind that you're receiving is property or equipment, you might look at sales, at similar sales, or potentially replacement cost. So for example, if someone's willing to donate an office building to you to operate out of, and they've said, we're going to assign deed of this office building over to you, there are lots of ways you can estimate fair value. And one of those ways might be that you go out and you see what similar sized office buildings in similar locations as this one are selling for, and you estimate that fair value based on those costs. Appraisals might also be a good option for transactions that management believes are material to the financial statements. The really nice thing about appraisals is that it's a third party that's an expert in an area, and they're taking a really deep analysis, a look and analysis at the value of that non-financial asset. And it can really be the best way of obtaining valuations for assets that might otherwise be hard to value. So think here about if somebody walked into your organization with a Picasso and said, here you go, we're donating this Picasso to you. That is not something that you can probably easily determine a value for without soliciting the help of a professional. Same if you have some unique real estate that's being donated to your not-for-profit. Maybe they've given you a plot of land way out in the mountains bordering a national park. What's the value of that? It's really hard to say unless you're a professional. Mineral rights are another one that generally we might see appraisals used to determine values. Anything like that that's more unique in nature and kind of hard to put a finger on unless you're working in an industry that's accustomed to performing those valuations. The not-for-profit might also look to see if there is industry published data that could help them in determining a value. One common thing that we see here is in the food bank industry. Food banks commonly will value donations of food on a per pound basis. So if somebody brings in a large amount of donated goods, the food bank might weigh those goods and determine the value based on a rate that's published by Feeding America. That's a way where they're taking industry data times the actual donated goods to arrive at the fair value of those donated goods. Not-for-profit might also look to market evaluations. Again, this might be common in a space where donated lease space or things of that nature are being provided. So somebody says, you can use our building, 10,000 square feet of this building to operate your not-for-profit. In order to determine the value of that, you might go out to the market and see what would it cost me to lease 10,000 square feet of building. A not-for-profit recipient should record contributed non-financial assets when they have discretion in using or distributing those gifts in kind. Discretion in this context is really analogous to variance power. So at the point in time that the not-for-profit controls the use of the donated good or service, they have a contributed non-financial asset. So really want to look at what point in time does the not-for-profit control what happens to that asset? When do they have the risks and rewards of ownership over the gift in kind? This might be things such as a risk of loss if the good is damaged, if the good is lost, or if it's destroyed. When do they have the ability to obtain the benefits of that good or control others' access to those gifts? Usually this is going to happen at the point in time that the not-for-profit takes physical possession of the gifts, but it could also be in circumstances when the not-for-profit takes constructive possession. So for example, we have some clients that have donated goods that are held in a third-party warehouse. The not-for-profit has contracted with donors to bring those goods to the specific warehouse, and the warehouse holds those goods for them until the not-for-profit is able to use them. In this situation, the not-for-profit does not specifically have control over those assets, but it has constructive possession, meaning it's responsible for letting the warehouse know when things can be released. So it really controls those goods, even though they're not in their immediate possession. I want to spend a couple of minutes to look at a few of the more common contributed non-financial assets that we see within our client base. And really, this is to make sure that we're all kind of on the same page of how things are recorded. Because while the standard does not impact the recording of contributed non-financial assets, it is important to make sure that they are properly recorded, because the presentation and disclosure matters that we're going to walk through in a few minutes couldn't possibly be correct if the numbers in the financial statements are not correct. So first to point out, is that it's not uncommon for a not-for-profit to have some uncertainty here in when and how things are recorded in the financial statements. It's definitely an area that, even depending on the type of contributed non-financial asset, could be a circumstance where it gets a little gray as to whether or not something should be recorded. Let's look first at contributed services. So contributions of services are recognized in the financial statements if they create or enhance a non-financial asset, or if they require some type of specialized skill that is being provided by individuals who possess those skills, and the services are such that they would typically need to be purchased if they were not being donated to the not-for-profit. So some examples to think about here of transactions that would be recorded in the financial statements are donated architecture on a building project. So let's say we're embarking on building a new space to operate in, and we've conducted a capital campaign. We've got a lot of financial contributions, and we have the architect of the project comes to us and says, we really love the mission. We want to donate to your project, but we would like to donate in the form of donated services. So we're not going to charge you at all for our architecture services. This is a case where, as we think about the accounting for this, we would recognize the revenue for the donated architecture services as a direct offset to the debit that's going to increase our construction in progress on that project. This is a case where a non-financial asset, that is our building, is being increased by the contributed services from the architect. Other common examples might be when an attorney is donating time to help your organization with bylaw changes. This is, again, meets that criteria of something that would need to be obtained from outside of the organization if it was not being donated. Attorneys definitely possess a specialized skill that puts them into the category of having the time that they donate to your organization being recorded as a contributed service. Other things that you might see might be if we have a national keynote speaker that's willing to donate their speaking time at a major fundraising event. That would be something that would probably be recorded as a donated financial asset in the financial statements under the contributed services category. Examples of things that would not be recorded in the financial statements as a contributed service would be volunteer time of people serving meals at a soup kitchen, volunteer time of the board of directors, the volunteer time of the ticket takers that are taking tickets at that big fundraising event that you're conducting. You know, those services are definitely vital to so many things that a not-for-profit organization does. And by no means is the standard trying to discount the value of those services to your organization. Rather, it's recognizing that there's not a specific level of skill that's required to be that level of volunteer, meaning that is something then that does not get recorded within the financial statements. It's also important to note that revenue recognition is not impacted by the consideration of whether or not your not-for-profit could afford to purchase the services at fair value on your own. Rather, the recognition is based on those specific elements of whether or not the service enhances a non-financial liability or requires some type of specialized skill. Really taking a step back and looking at the value of what's being provided to the not-for-profit. So let's look next at the use of property and equipment, which are forms of contributed assets, and thinking again here about the determination, that the determination of recognition is not affected by whether your organization can afford to pay for the contributed property and equipment. Rather, this is a benefit that you're receiving and something that ends up being recorded in your financial statements. This is something that typically happens in one of two ways. Either the donor contributes the property and equipment to the not-for-profit and releases all legal title to that long-lived asset, or more commonly, I think what we see with our clients is that they are contributed property and equipment to the not-for-profit, but the contributor retains the right and legal title to that asset. And rather they're saying you can use the building or use a set amount of space. So really that free rent concept, that's another form of contributed property and equipment. So if you're receiving donated assets where the legal title transfers to your not-for-profit, this is a circumstance where you may want to get an appraisal to help with that evaluation. Or you could potentially look at comparable sales in the area to estimate the value. The reason we usually like to see an appraisal here is because this is typically not a contribution that is small. It's usually something that's very impactful to your organization, and we really want to make sure that you're taking the proper value for that contribution. In circumstances where your not-for-profit is receiving the right to use property, but isn't receiving title to the donated rent, the not-for-profit might estimate the value of that leased space by performing a market analysis to determine how much they would have had to pay for rent in a similar space and similar location. So let's think about an example here. It might be, if your not-for-profit is receiving a $1 a year, 99-year lease. There's some value there for your organization. And how that's recorded is really dependent on whether that $1 a year, 99-year lease is conditional or unconditional. If the contribution is unconditional, you're actually going to approach this very similarly to the way you would approach it if you were receiving a financial promise to give, meaning you're going to estimate the value of that contribution to your organization and record that entire value at the time the contribution is given to you. So that'll be at the net present value, meaning you're going to estimate the fair value by projecting that out. If you decide that it's worth $100,000 a year, you're going to take that over 99 years and then discount that back to present value. That amount will be recorded as a with donor restricted net asset because there is an implied time restriction there, and you would release that from restrictions over the term of that lease. One important thing to remember here, though, if you are in that circumstance, is you would never record a fair value that is greater than the actual value of the property that's being donated to you. So when I think about that 99-year lease, if I think it's worth $100,000 a year and I project that out over 99 years and discount that back, that's a pretty big number. If we look at that number and we say, yeah, but today's value, we could buy that land for $300,000, then our long-term promise to give is capped at that $300,000. So, as you can see, a really unique scenarios when it comes to fair value considerations of contributed property and equipment. There are also circumstances where a not-for-profit is receiving media and advertising time at no charge. When that time is being used to highlight the organization and its mission, or is encouraging the public to contribute to the not-for-profit, and if the not-for-profit has active involvement in determining the messaging and the use of those materials, the not-for-profit has received a gift of a non-financial asset in the form of donated media and advertising. And that should be recognized in the financial statements as revenue. So some common examples that you might see here are if a radio or television station prepare a public service announcement highlighting your not-for-profit organization, or if you're given, free commercial airtime, or you've got a website that's allowing you to publish an ad that's soliciting donors to contribute to your organization. Those are all things that would likely generate the recognition of revenue in your financial statements. It's important to distinguish that between regular news stories that might happen that highlight your not-for-profit organization. For example, I recently helped our local United Way with an interview on a TV station, and we had a very little spot on that interview where we talked for about 30 seconds about the things that the United Way does in our community. That's not something that generates media and advertising contributed non-financial revenue in United Way's financial statements because it wasn't really the crux of what the news article was covering. On the other side of the coin, though, we also did a radio spot in our local Sioux Falls market that was really promoting the United Way and talking about all the great things that our United Way does in the community. That's something that likely would have qualified for contributed non-financial asset recording in their financial statements because the entire 10-minute interview was really focusing on the programs of the United Way. Okay, so now let's tie all this information into ASU 2020-07, presentation and disclosure by not-for-profit entities for contributed non-financial assets. So the FASB issued this accounting standard, and the FASB is the Financial Accounting Standards Board, issued this accounting standard update to improve generally accepted accounting principles by increasing the transparency of contributed non-financial assets for not-for-profit entities by enhancing the presentation and disclosure requirements. As we've just spent a few minutes outlining, the recognition and measurement process for gifts in kind for a not-for-profit can be difficult and subjective. There are a lot of nuances and a lot of things to think about when valuing contributed non-financial assets. So the amendments in this update address certain stakeholder concerns about the lack of transparency about the measurement of contributed non-financial assets that are recognized by not-for-profits, as well as providing more information to readers about how the not-for-profit uses these contributions in their programs and other activities. The changes, really the crux of them is that they're requiring a not-for-profit to present contributed non-financial assets as a separate line item in its statement of activities, apart from contributions of other financial assets. So commonly what you often see now is one line on a not-for-profit's financial statements that says contributions. And that will include contributions of cash, promises to give, contributions of stock, contributions of gifts in kind. You name it, it's usually in one line called contributions. This standard is requiring that contributions of non-financial assets be separated in the statement of activities and shown separately. This is so that a reader could look at the statement of activities and see right away how much the organization has received in non-financial assets. And we're going to spend a little bit of time looking at a few examples of the presentation changes here in a few minutes. The changes also implement significant disclosure changes to the financial statements. So let's look at those disclosure statements changes and how they impact the financial statements under the new accounting standard. First, a not-for-profit is required to disaggregate the amount of contributed non-financial assets recognized within the statement of activities by category of the type of non-financial asset. So as I mentioned, on the statement of activities itself, there's going to be one line called contributed non-financial assets. And you could have more if you wanted to, but at a minimum, one line, contributed non-financial assets. When we get into the financial statement disclosures though, the not-for-profit is going to have to chunk that up into categories. So it might be donated legal services. It might be contributed vehicles. It might be contributed property and equipment. Whatever the separate categories and components are that make up that statement of activities line, that needs to be disclosed in the financial statements by category. And then for each category of contributed non-financial asset that is disclosed, you're required to provide qualitative information about whether the contributed non-financial assets were monetized, so were they sold for money, or utilized, were they used in operations during the reporting period. If they're used, the not-for-profit also has to include a description of the programs or activities that used those assets. The not-for-profit needs to disclose its policy, if they have one, about monetizing rather than utilizing contributed non-financial assets. So let's think here, if you're an organization that commonly receives donated vehicles, maybe, I think about that Cars for Kids commercial that I hear on the news all the time about donating cars to this Khan Academies or something like that. That's an entity that might have a policy for what they're going to do with those cars when they come into the door. Are they going to repair them and sell them? Are they going to use them in operations? Are they going to immediately liquidate them? What are they going to do? If your organization has a policy about how you're going to use non-financial assets, you need to disclose that in the financial statements. You're also going to provide a description of any donor-imposed restrictions associated with the contributed non-financial assets. So for example, let's say that your not-for-profit receives a large donation of hygiene kits that are required to be used only for homeless youth outreach. That's something that gets disclosed within the footnotes when you have your line item that says donated hygiene kits. You're going to have to also include a disclosure that says those can only be used for the homeless youth outreach program. You have to include a description of the valuation techniques and inputs used to arrive at fair value in accordance with the fair value measurement topics. So, thinking about this, take a step back to when we talked about fair value. How did your organization determine the fair value of the donated office space that you recorded in the financial statements? Did you look at comparative market analysis? Did you go to a real estate broker and say, what would we have to pay? If you received an allotment of used desks, did you go to a furniture warehouse and say, all right, if we were buying this similar desk, what would the price be? You have to include all that information in the financial statement disclosures so that the reader understands how you came up with the value that's recorded in the financial statements. Finally, you're required to disclose the principal market or most advantageous market used to arrive at the fair value measure. If the market in which the recipient not-for-profit, if it's a market in which the recipient not-for-profit is prohibited by donor-imposed restrictions from selling or using the contributed non-financial asset. So that's kind of a mouthful, but if we think about it in an example format, if a donor if the donor gives you some contributed non-financial assets and they require that you only use those assets within the city limits of your office building, but you know that the principal or most advantageous market is located all the way over on the East Coast, you have to disclose that there is that limitation. You're basically just saying, we're prohibited by the donor from using this donated financial asset anywhere but this specific location, but this is not the principal or most advantageous market. And the reason that's important is those are key factors in determining fair value. So it lets the user know that you were using something else at that point. For contributed services, the not-for-profit should also disclose their programs or activities that used those services, including the nature and extent of the contributed services received and recognized as revenue during the period. Entities are encouraged to disclose the fair value of contributed services received but not recognized as revenue during the period also, if that's practicable. So if you're recognizing the contributed services as revenue, you definitely need to disclose the value of those services. But it's also encouraged to disclose the value of those volunteer hours that you've determined cannot be recorded in the financial statements if you're able to practically estimate that fair value. The nature and extent of those contributed services that are received can be described by providing non-monetary information as well as monetary information. So maybe you're going to describe it based on the number of donated hours that you've received, or the number of meals served by volunteers, things of that nature, things that highlight the good that the volunteers are doing in a non-monetary way. Or you could provide it in monetary information, such as the dollar amount of contributions that have been raised by volunteers. So a lot of options here, thinking about what is really telling the story about your contributed services. The overall disclosure of contributed services is required regardless of whether the services received are recognized as revenue in the financial statements, but the extent of the required disclosures definitely changes when services are recognized. Need to make sure that you're disclosing all the elements that are required by the standard if they're being recognized in the financial statements. And again, kind of taking a big step back and looking at all this, the purpose of the changes implemented by the standard are to increase the transparency to users and to help them really understand the impact that gifts in kind have on the financial statements. A concept that's important in the fair value considerations and also making sure that the disclosure is accurate is regarding the principal and most advantageous market. So the principal market is the market with the greatest volume and level of activity for an asset or liability. And the most advantageous market is the market that maximizes the amount that would be received to sell an asset or that would be paid to transfer a liability after you take into consideration transportation costs and transaction costs. So again, this is important to understand, particularly when you're considering valuation of gifts in kind that exists in a need that's outside your coverage area. So I think what we commonly see here is if there's a need that's primarily in a developing world rather than a US market, it might be a case where the principal market concepts, so that's the market with the greatest volume, indicate that sales in that developing world market would be the market that we should use for fair value considerations. But that might not be the most advantageous market because it's harder to get product overseas than it is to deliver it within the US. So it's inherently more costly and complex to complete those overseas transactions. And this is really important again, because not-for-profits that don't have a good understanding of the market differences could inadvertently start their valuation process at the wrong level, which could impact those fair value considerations. So ASU 2020-07 is effective for annual periods beginning after June 15th, 2021, and interim periods within annual periods beginning after June 15th, 2022, with early application permitted. So that means if you're listening today and you're a June 30 year end, this standard will be effective for your next fiscal year end, June 30, 2022. If you're a calendar year not-for-profit organization, this is going to be effective for your December 31st, 2022 financial statements. So a little bit of a twist here, because normally what we see are the December 31st year ends are adopting before the June 30 year ends, but this is working a little bit of the opposite this time. The transition guidance for this accounting standards update requires a retrospective application to all periods presented, which means that your comparative financial statements need to reflect these changes. So you're going to have to make the presentation and disclosure changes required by the standard for all years presented. Okay, let's look at a couple of examples to kind of really try to hone in what this is going to look like in your financial statements. So the first example comes directly from the standard. And what you'll see here is that we've got contributions up here, as was previously reported, as one line on the financial statements. And the way the standards work is it strikes out things that are changing and underlines things that are new, which is really helpful in kind of showing you how this might look in your financial statements. This is an example of a statement of activities that uses what we refer to as a pancake format, meaning we start with net assets without donor restrictions at the top and work down till we get to net assets with donor restrictions. So as you can see, we've got contributions. Under the new standard, though, those are going to be broke out into two lines: contributions of cash and other financial assets and contributions of non-financial assets. So the component that is up there at the top is without donor restrictions, and the component that down here at the bottom is with donor restrictions. So very simply, that's how the presentation and disclosure will change in this type of statement. If we look also at another common presentation where we've got the with donor restrictions and without donor restrictions in the pancake or in the side-by-side columnar format, we see here that we've got without donor restrictions and with donor restrictions. And the presentation is essentially doing the same thing. It's taking the one line of contributions and breaking that out into two lines: contributions of cash and other financial assets and contributions of non-financial assets. When we look at the disclosures, this is really where the meat of the changes is going to be. So we've got here an example disclosure of donated professional services and materials. And we're saying that donated professional services as of December 31st were as follows. And we can see that we've got the categories here in a table format, which was our very first requirement. We're categorizing that out by the type of donated non-financial asset. What you'll also see in this sentence is it says, unless otherwise noted, contributed non-financial assets did not have any donor imposed restrictions. So what this is accomplishing is that piece of the standard change that says, if there are restrictions, you have to let the reader know that. And then we go on to say, contributed educational services recognized are comprised of professional services from specially trained educators assisting in the organization's training programs. So if we think back to our required disclosure changes, we cross a lot of things off of the bucket here. We cross off the type, so the category of non-financial asset. So we've got we're saying those educational services are comprised of professional services from specially trained educators. So that's how we know that we could recognize those, because it's a specialized skill. And we're using them in our training program. So we've also disclosed how we're using them. And then if we go to the bottom part of that disclosure, we'll see that they say the contributed services are valued and reported at their estimated fair value in the financial statements based on current rates charged for similar services. So that's how we know that how our not-for-profit valued the use of those services. The rest of this disclosure covers the contributed goods. So we had some contributed food and supplies, and we're saying here that we're going to use that in our worker training program, and that we estimated the fair value of each pound of food using a rate established by a national organization. So that's letting the reader know how we came up with that dollar amount that's included in that category. The contributed building is going to be used for all of the program activities, and then similarly talking about how we valued that contributed building. And then the very last kind of component to check off on the disclosures that the disclosure changes that we just talked through was this particular organization has a policy to sell all contributed vehicles immediately upon receipt at auction or for salvage, unless the vehicle is restricted for use in a specific program by the donor. No vehicles received during the year were restricted for use, and all vehicles were sold in accordance with the policy. The value reflected in the financial statements is based on the cash proceeds received at the vehicle's disposition. So what you can really see here is a lot of great information being provided to the reader to let them know how our organization valued those vehicles. Okay, we have another example here on donated medication. And this example, it highlights when you would potentially make a disclosure about the principal and most advantageous market. And so in this particular scenario, our organization received a contribution of $25 million of donated medication, but the medication could only be used outside the US. So we had to use this in the international health services and natural disaster services outside of the US. So part of the medication was legally able to be sold in the US, and a part of it is not. But in any case, it had to be used in our international market. So in valuing the donated medication, our organization looked at the two components, and they said for the medication that's legally permissible for sale in the US, we're going to use this price. And for the medication that's not, we're going to use a different price. And so it's really just providing information to the reader about that process. Okay, so the last slide is another example of a presentation and disclosure requirement that the not-for-profit entity could use to show all those disclosure requirements that we just covered. So it's basically just another way where you would use more of a tabular format to determine or to provide all the same information, but in another form of display. So just another example that you might be able to use when compiling the footnote disclosures. And with that, I think what I want to do is try to figure out a way to look at the questions that have come in on chat, but I don't have any.
I can read them to you, Angie, if you would like. I apologize to Barbara because I actually accidentally deleted her question, but she asked, how does it work if we donate the gifts in kind to another nonprofit organization or a portion of it?
Yeah, so if you're donating the gifts of non-financial assets, you're going to record those at the fair value of the contribution. So you're going to determine the fair value of those non-financial assets that you're donating, and then that's what you'll record as contribution expense in your financial statements. So let's think about if you're donating that Picasso, like let's say your organization is the owner of the Picasso, and you decide that you're going to go ahead and donate that to another entity. You're going to likely do an appraisal or some type of valuation on that Picasso before you transfer those goods over to the other entity, and then that will be recorded in your financial statements as contribution expense.
First question we had earlier on was, would goods being provided at a substantial discount be recorded as goods in kind? For example, if we received 1,000 frozen turkeys for $10 each, when the fair market value is $25 each, would we record the $15 each as gift in kind revenue?
Exactly. When you're looking at your contributed non-financial assets, particularly in that materials and supplies, if you're a food bank and you're getting the donated turkeys, you're definitely going to look at that donated below fair market value price and determine that value.
All right, that was Matthew's question. We had the question from Tim, who said, if the non-financial asset that is gifted is over $5,000 and the donor wishes or intends to deduct for tax purposes, the donor has to have the asset appraised. Can the nonprofit simply use the appraised value the donor identifies on the IRS form 8283 that the nonprofit signs for the donor?
Yeah, definitely. What you'll want to do in that circumstance, though, you could certainly use it. You just want to make sure that your not-for-profit is free of any conflicts with the appraiser. So you're going to want to take a step back and think about relationships that you have. If that appraiser is somebody that's on your board of directors, you might need to look outside of that for a second check of the appraiser, just to make sure that you're really getting an independent value of that donated non-financial asset. But certainly, and it's very common, what we see that the donor will provide the not-for-profit with their appraisal. There's just a little bit of due diligence that you're going to need to do to make sure that it's appropriate for your organization to also use that appraisal. But certainly a good way to kind of save some costs potentially there.
Awesome. All right, Angie, another question from Barbara. We operate a thrift store. We do inventory at the end of the year and we subtract the sales from that number to determine the in-kind donation value. Is this a proper valuation practice? It would be almost impossible to value every item that comes in individually.
Yeah, thrift store, the donation of items to thrift stores is really unique. That's actually not a method that's supported by generally accepted accounting principles. Really what you need to be doing is looking at, establishing some way to value the inventory when it comes in the door. And then that becomes inventory that gets moved to cost of sales when the inventory is sold. So definitely understand that that's a common practice. But there's more layers that really should be happening in that space. So I'd probably recommend that you reach out to your Eide Bailey team to talk about the different options there to practically value that.
All right, Angie, we've got a question from Burke who, this may have been answered already, but can you speak specifically to donated advertising? It's not really something that I take possession of. What about airtime a radio station spends raising money for your charity?
Yeah, and so we did have a slide on that. So if you download the slides, be sure to pop open and grab that slide. But high level, if that media advertising that's being provided to you is something that's really enticing donors to contribute to your organization, or if it's a public service announcement specifically about your organization, if it's something of that nature, then that is something that should be evaluated for recognition as a contributed non-financial asset in the financial statements. It's really important that you have control in that process. So you want to make sure that your organization is a part of putting together that media or print advertising, that even though you don't take possession of it ahead of time, that you're involved in putting it all together. And if those criteria are met, then you can certainly record that in the financial statements.
All right, we've got multiple questions, but just 1 minute left. Angie, do you want to respond to the questions afterwards and we can send out responses to those questions?
Yes, certainly. If you submitted a question and we were not able to get to it, why don't, we'll take a look at what those questions were and we will separately respond to you with the answers to those questions.
Okay.
All right, and with that, I want to thank everyone so much for joining us today. I was glad to be with you all today, and I hope you all have a fabulous Friday.